Today, we're putting on our doctor's coats and giving the Indian stock market a full health checkup. You know, after a really long run of feeling great, it's starting to show some signs of a fever. So, let's take a look at the very first symptom. And here it is, the main event. After a pretty solid positive streak that started way back in April, the market's short-term trend has officially flipped to bearish. Now, that's a huge shift in sentiment, and it really all boils down to one single number.
That number is 24,565. That's where the Nifty index closed recently. So, why should you care about this specific number? Well, think of it like this. For market analysts, seeing the Nifty drop below a key technical level like this is like a patient's temperature suddenly spiking. It's a really clear signal that we need to dig deeper and see what's actually going on under the surface.
So yeah, this drop, it's our first big symptom, a sudden market fever. Let's go ahead and diagnose what this bearish turn really means for investors right now.
Okay, to understand any fever, you have to check the vital signs, right? So now we're going to look at the core data, the numbers that are actually driving this downturn. Think of this table as the market's main health dashboard. And what's immediately obvious when you compare the numbers now to just a few weeks ago, pretty much every vital sign is pointing down. The Nifty, the PE ratio, you name it. Let's break down two of the most critical ones. First up, the market cap to GDP ratio, which is sitting at a hefty 135.50%. This is basically the market's blood pressure. A high reading like this suggests the market might be a bit overvalued, maybe even overheated, especially when you compare it to the size of the actual economy. And for context, anything over 130% is generally considered pretty high. Now this number. This tells you where the big money is flowing. It's the net change in market bets from foreign institutional investors, or FIIs. When you see a big negative number like this, it means that major global players are getting defensive. They're increasing their bets that the market is more likely to go down than up. So the short-term diagnosis seems to be proceed with caution. But what about the long game? You know, the long-term prognosis? For that, we're going to turn to a really famous tool for forecasting future returns. We're talking about the Buffett indicator. Yep, named after Warren Buffett himself. The concept is actually pretty simple. You just take the total value of all stocks in a country and divide it by that country's GDP. The big idea is that, over the long haul, the stock market's value should probably grow in line with the economy. It gives us a framework for what potential returns might look like. And here's the forecast. The model predicts an annual return of about 6.3%, but, and this is a really big but, look at how we get there. The return is getting a nice boost from economic growth and dividends, but it's also being dragged down by this valuation reversion piece to the tune of negative 2.1%. What that means is the model expects today's super high valuations to eventually cool off and come back down to their historical average, which puts a lid on future gains.
So given the short-term fever and a more, let's say, modest long-term outlook, what's the doctor's prescription? What should you actually do? Let's get into the strategies the analysis suggests for navigating this kind of environment. The prescription basically comes in three parts. First, and this is crucial, don't panic. This dip could be a good opportunity to accumulate investments systematically, through SIPs or STPs. Second, focus on stability. This might not be the best time for super aggressive bets. Think about prioritizing large cap and hybrid funds to keep your portfolio anchored. And third, if you have a 2 to 3 year timeline, you might want to look at business cycle funds, which are built to perform well in the specific part of the economic cycle. And for those who want to target specific areas, the analysis points to 3 sectors in particular. Banking and finance are on the list because of strong credit growth and really stable fundamentals. And then there's defense, which is looking good because of a really solid pipeline of orders and more government spending in that area, making these sectors pretty resilient right now. So that brings us to the final and, let's be honest, the most important question. After our whole health checkup, what's your next move? How do you balance these clear signs of caution today with that underlying optimism for tomorrow?
So here it is, the final diagnosis. We've got a market that is definitely cautious in the short term, weighed down by those high valuations and some defensive moves from foreign investors. But the long-term story, while maybe a bit more modest than before, is still a story of growth. The data seems to suggest a path of steady, systematic accumulation, not panic selling. The real challenge for every investor is figuring out how to separate the short-term fever from the long-term prognosis. So how will you navigate all the noise? Thanks for joining us on The Explainer.